A large majority of option traders end up losing money in the long run. And in today's webinar, we are going to discuss the exact reasons why that is the case. We are also going to introduce certain frameworks using which you can move over to the small minority of option participants who use options very profitably over the long term. And when I say long term, I mean decades. So to benefit from this webinar, please ensure that you're watching till the end, because we have introduced some very innovative strategies and we have discussed a few case studies which you'll really benefit from. And I will really appreciate if you can like this video and you can subscribe to our channel. It does not cost you a penny, but it really helps us with the YouTube algorithm. A lot of work and preparation goes in conducting these webinars, and your subscription to our channel will really help us with the algorithm. So let's move over to the webinar.
So we like to get in and understand a business very deeply, and then we like to research a company from every aspect over a long period of time. And when we are researching a company, the company might be overvalued, but that does not deter us from getting deep into the business, because we know if we are patient, the buying opportunity always presents himself, as we are seeing these days. So that's when the challenge of generating a cash flow to keep buying comes up, and that is what we are going to address today. So the relationship equation, which does most of the heavy lifting in the world of finance, and also on which the long-term wealth compounding depends on, is this equation. Now, this formula, that return on capital, as long as it is greater than your cost of capital, then your investment is basically adding value to yourself. Now, whether you're a company or whether it's your personal investment, now at a very simple term, think about this. If you're borrowing money from a bank to buy a property, and if your return from that property is lower than the interest rate, which is in this case the cost of capital that the bank is charging you, then it's not a good purchase. It doesn't make sense to do that, right? So similarly, when a business is investing in some initiative, and they're funding that initiative, they always need to ensure that the return on capital employed, which is basically the total capital that has gone into the business, this also includes the cash which is sitting on the balance sheet. So as long as that return is higher than the cost of capital, which in case of a business, it's the opportunity cost. In case of debt, the cost of borrowing, and in case of equity, it's the opportunity cost of the equity holder. So then the business is value accretive to the shareholders. And we will keep coming back to this formula, because this is a very important relationship to keep in mind. Okay. Now, why options matter? Now, I see that our attendees today are at different levels, which is not a problem at all, as we have something for everyone. Like always, we will build on the concepts that we have covered in the past, and we will keep adding new concepts. I like to progress in a slow pace, because this is not a sprint. This is not something that we can learn in 2 weeks and then then go out and start doing stuff. Yeah, we can do that, but to acquire real expertise, it takes time, and it takes a significant amount of commitment. And for the few absolute beginners here, some of the concepts might be a bit challenging, but don't worry, stay with us. We will put the building blocks together. I will do a recap of the basic concepts, and we will put the building blocks in place and show you the clear pathway to progress from basic to advanced level. And that is what has happened with many of our subscribers who are here, who now have voted that they are very comfortable using options. And I remember that some time back, they were also complete beginners. So don't worry. I also used to be a complete beginner at one point of time. Okay, so what we will do is, for the sake of the beginners, we will do a quick recap of the structure of an option. Now, these are some of the points which we will go through. Now, every option has an underlying security or an instrument. Now, in this case, we are predominantly going to deal with equity options, where the underlying security is the stock. There are two types of options. One is the call option, which is basically the right to buy, and a put option is right to sell. So an option gives us the right to either buy the security or to sell the security. So if we own a call option, it gives us the right to buy. If we own a put option, it gives us the right to sell. Every option has an expiry date. Unlike a stock, which does not expire unless the company goes bankrupt, every option expires. This is very similar to an insurance policy, just like an insurance policy has a certain validity period, same is the case with an option. An insurance policy is actually nothing but a put option, Now, this is how the expiry dates look like. So options, they started with monthly expiries, but then they also have quarterly expiries. And now majority of the options, they have weekly expiries. So we have options expiring every Friday of the week. And there are some underlying security which has options expiring every couple of days. I have personally lost track. I don't use these very short-term options, but I just noticed that they have introduced these, and CBOE keeps introducing new innovative ways of using options. Now, every option comes with a strike price. Strike price is the price at which the right to buy or sell can be exercised. So, for example, let's say Apple's stock price is 112 per share. This is an old screenshot, but the concept doesn't change, so I haven't changed the screenshot. Now, this option, which is highlighted, this option has an expiry date of 16th October 2020, which is 35 days from the date of this screenshot, and the strike price is 120. This means that this 120 strike call option entitles the holder of the option to purchase Apple shares at $120 on or before 16th of October, irrespective of what the share price is on that particular day. Even if the share price is $200, the owner of the call option will be able to buy the call at 120. Multiplier is the number of units of the underlying security that an option controls. In option, we talk of contracts. So one contract of these equity options, like the option on Apple, controls 100 shares. So one contract, it gives the owner right to purchase 100 shares of Apple at this price on or before this date. Now, mind you, while in most of the common options that we use, they come with a multiplier of 100, but there are options in other markets which have different multipliers. Like in some of the European markets, you have multipliers of 10. There are even options which have funny multipliers, which is not even a round figure. Okay, so the important thing is to always check the contract before you are using an option, and ensure that you exactly know what the multiplier is. The premium is basically the market price of the option, which the buyer needs to pay to acquire the right. Just like when you buy an insurance policy, you need to pay a premium. So it's exactly the same. So in this case, this option has a premium of $3.50, which means that the total amount to be paid for one contract is $3.50 multiplied by 100, which is $350. Now, interesting thing is, if Apple shares go to zero, then if you are a stockholder, you lose the entire investment. But in case of an option holder, you just lose the option premium, which is $350. So that is the benefit of having a leveraged instrument. Whereas if, let's say, the share price goes to 150, you end up making almost a similar amount that the stockholder will who bought the stock at 120 will make. In this case, it is $30 multiplied by 100. But for the option holder, we'll make 30 multiplied by 100, which is 3,000, minus the premium of 350, which they paid to buy this option. So it's pretty straightforward. The call option is a right to buy 100 shares or any underlying security at a certain strike price on or before the expiry date of the option. Now, as you can imagine, as the share price increases, the value of the call option increases in a leveraged manner, and vice versa. So similarly, in case of put option, it is the right to sell the stock. So if the share price decreases, the value of the put option increases. Now, the price of an option, which is basically the market price of an option, should always be greater or equal to the benefit the owner can get by exercising the option, which is basically the intrinsic value of the option. Now, if that is not the case, then it will be suboptimal for the owner to accept the market price. I'll give you an example. Let's say if I have a wallet which has a $100 bill in it. Now, does it make sense for me to sell that wallet? I mean, however old and tattered the wallet might be, does it make sense for me to sell that wallet for less than $100? I mean, it will be silly, because the wallet has a $100 note in it. So that establishes the intrinsic value of that wallet, which is $100. So I can sell it for any price higher than $100, but definitely not less than $100. So same is the case with an option. So an option premium basically has two components. So these two components of an option premium is intrinsic value and the time value. Now, intrinsic value of an option, of a call option, is basically the share price minus the strike price of the call option. For example, in this case, the Facebook stock price is at $329. So the $350 option, that is the call option, has no intrinsic value because the person owning that option, he or she can always go to the market and buy Facebook for $329. So it does not make sense for that person to exercise his right. However, they might still decide to buy this option, maybe because they're speculating that the share price is expected to go up. So they can buy this option at a cheaper price. Whereas the 300 strike call option has an intrinsic value of $29.13 because the owner of the call option can just exercise the right of purchasing Facebook at $300 from the market and then go and sell Facebook immediately at $329.30. So there's an intrinsic value of 29.13. The extrinsic value of an option is the part of the market price over and above the intrinsic value. It is also called the time value of an option. So in this case, for the 300 strike call option, it already has an intrinsic value of 29.13, but the option premium is 53.7, which means the extrinsic value is the premium minus intrinsic value, which is 24.57. It's pretty straightforward. Okay. So the extrinsic value of an option decays with the passage of time. As an option approaches expiry, the extrinsic value tends to zero. On expiry date, the extrinsic value vanishes, and the only thing that remains is the intrinsic value. So this tattered old wallet that I talked about, so with the passage of time, that will probably just disintegrate, and eventually nothing will be left but that $100 bill. So that is exactly how the time value of option is. Okay, so let's move on. Now, here is an option secret. Why do most option traders don't end up making money in the long run? Now, this is how. Now, there can be different types of strategies to use options. You can be buying options. You can follow a long option strategy where you always buy option, or you can follow a short option strategy where you mostly sell option. Now, both of them serve their purpose, but typically, if you're just doing a long option strategy, your equity graph will often look like this. So you will have sudden violent moves in your favor, like these moves when the underlying security moves in your favor, but then you will have long periods where the option premium will eat into your overall equity when the underlying security is not moving in your favor. It's very similar to a lottery ticket. If I decide to go and buy a lottery ticket every single week, so in most of the time, the lottery ticket will expire worthless. I won't win anything. But suddenly, if I'm lucky, one fine day, I might just, win some money. And again, I will keep, bleeding money because of that. So it's exactly the same. And when the next move will happen, no one really knows. Often traders, try to delude themselves with all kinds of analysis, thinking that they can predict the short-term moves in the market. But the recent events in the markets, I hope, have showed them that you really cannot predict. Yeah, from time to time you will be right, but over the long term, it's just not possible. It's not knowable because it depends on lots of factors, and human emotions are involved. So why someone is selling, why someone is buying, they all have their own reasons. Okay. Now, markets like these are deathbeds for long option strategy holders. They will completely get decimated. But these markets are a gold mine for option sellers. So an option seller would typically, go and sell puts below the lower range of the market and sell calls above the upper range of the market. And by the time the options expire, they will keep all the premium, and the option will expire worthless because these options above and below the range, they have no intrinsic value, right? They just have time value. And we have seen that the time value decays to zero. So these option sellers will end up making a lot of money. So that means it must be a really good strategy, right? Well, when you have the markets going upwards, like what happened in the early parts of 2021 and the later parts of 2020, this is when the put option sellers, they were making a lot of money. And this is when, you'll see a lot of Facebook posts bragging about how much money they're making. And then suddenly this happens and their face gets ripped off, when you're a short option trader. Because typically these traders, they're selling options and then they're hoping and praying that the stock price should end up above the option strike price. So this is what happens. Now, in case of a call seller, here they would be making a lot of money during markets like these, and then suddenly, if there is a sudden up move, they lose their face gets ripped off. So when neither long call or puts, long or short puts or calls seem to be working, and typically what happens is, when someone starts trading options, maybe for some time they see success and they feel very caked. They feel, oh, this is easy money, so I can keep doing that. And then suddenly, boom, something happens. So then after some time, they realize that, hey, this doesn't seem to be working. So then they become a little bit more advanced, and then they discover credit spreads. Okay, credit spreads are nothing but a pair of a short and a long option. So in this case, the lighter yellow, this is a short option being sold at this strike. And to protect the downside, the option seller would take part of the premium and go and buy a long option. So the risk is just limited. And in this case, due to these sudden down moves, they will still lose money, but it's much more contained. So, this seems like a good thing to do, but let's see, is it really? So here we have taken this case study, an example of a credit spread on Facebook. So here, let's say I have Facebook share price today's, this is basically in the past, around $329. So let's say I'm a credit spread seller. I go and sell a put option at $300 strike, and I bring in $2 of premium. By the way, I know there's a lot of information on the screen, but just follow my cursor and things will be clear. And then to protect my downside, I take 85 cents and I go and buy the 280 strike put. So 2 minus 85 cents is $1.15, and I do 5 contracts of those. So which means 5 multiplied by the multiplier of 100 multiplied by $1.15. So which gives me $575. And what do I do after that? When I say I mean an option trader. I'm not an option trader, by the way. So I would never do something like this. But a typical option trader would then just sit and pray, hoping that the stock price does not come down below the downside break even. And it's easy to calculate the downside break even. It's the $300 strike minus the $1.15, because that is a credit that they bring in. So if by the expiry date, which is 35 days away, 2nd July, if by that date, the stock price, which is this blue line, if it stays above this break-even point, then the option seller would keep the $575. So this seems like free money to him. But if that doesn't happen, if the share price goes below, and if it falls below 280, then the maximum loss will happen, which is $9,425. So in this case, the probability of the stock price staying above the break-even point is almost 84%, which is massive. And this high probability of winning is often very seductive. Now, what most novice option traders don't realize is they don't just focus on this probability, but the right way to think of it is not the probability. It is to think that, look, I can hit a winner on one trade, but it really doesn't matter what happens in one trade or 5 trades or even 10 trades. What really matters is what happens over the long run. And for us in MoneyWiseSmart, long run means over our lifetime, because it really doesn't help me if I end up making a lot of money for 5 years and after that I end up giving back everything. Imagine when I turn 80, sitting and bragging that, hey, you know what, I used to be a great investor from the age of 50 to 60, but after that I gave everything away. So it doesn't help, right? So the only term which matters to us is the lifetime. Now, unfortunately, when you're dealing with external financial advisors who are more focused on their bonuses and all, for them, it's very difficult for them to think long term. And that is where the incentive systems are totally misaligned. So the only person who can take care of your interests is you yourself. And that's why being educated is so important. I mean, being financially educated. Now, in this example, and by the way, options are instruments where we can actually calculate the probability of the option ending up in a profit or in a loss. Just like, we know the probability of a coin toss ending up in a head or a tail. But when we are tossing a coin in that particular instant, while we know that the probability is 50%, but we don't know whether this particular toss will end up in a head or a tail. So similarly, while we know the probability of a similar credit spread option strategy, 84% profitable and 16% it will end up in a loss, we would not know whether in this particular instance, whether it will be profitable or not. So what really matters is, we need to ask ourselves this question, that what if we keep doing this over a large number of trades, how will our situation look like? And that is where the concept of expected value comes in. Expected profit is nothing but the sum of the probability of an event multiplied by the actual outcome. So if I go and do 100 similar credit spreads, my expected profit would be 84 multiplied by 575, which is the probability multiplied by the maximum profit, minus 16 multiplied by 9425. Why is it minus? Because this is a loss. And that is not a pretty figure. So if I keep doing this over a long period of time, in spite of my first 5 or first 10 trades being profitable and I going and bragging about it on the Facebook groups, over a long period of time, I will end up as a losing trader, because this is a losing system. Now, how to build a winning system then? Now, in this particular case, if the probability, instead of it being 84%, let's say if it was 95%, so then the expected profit from 100 similar trades would be a positive figure. So that would be a winning system. Now, clearly, this credit spread that we did, I mean, however hoping and praying we would have done, I mean, this particular credit spread could have ended up profitable, giving us the $575, but it is a bad idea. And that would have been a situation of a bad process leading to a good outcome, but doesn't help us in the long run. Now, sometime back when there was a lot of craziness in the market going on about GameStop. Now here, we are not recommending that anyone should have just bought GameStop. There's a lot of madness that was going on, and a lot of people lost their shirts and their pants doing that, even though some made money. But we identified some very profitable option setups simply because we had a higher expected profit. So if at that point of time, someone sold a 40 strike put and someone bought a 30 strike put, bringing in a net credit of $3,300, the maximum risk would have been $6,700. This is how the probability would have looked like. There would have been a 93.3% chance of the trade being profitable, only a 7% chance of the trade ending up as a loss. So the expected profit from 100 similar trades would have been handsomely profitable. So this is this could have been a winning system. So this is the reason that first of all, we are not short-term traders, but there are times when we find these interesting setups, and we would only swing our back if the setup is really, really attractive, and if we are pretty sure about the expected returns being positive. Now, in this particular case, maybe this trade can end up being a loss-making trade, but it doesn't matter. As long as the expected returns are positive, we know that over a long period of time, we will be profitable. A simple example of this is, let's say, if I tell you that, if you enter a game of a coin toss, and every time you hit a head, the market will give you $1.10, and every time you get a tail, you have to give back 90 cents to the market. You will immediately know intuitively that this is a winning system. However, if I reverse the payoff, then you would know that that is a losing system. Now, let me tell you a funny story. Who knows? This is a map of which country? Can anyone identify? Maybe you can identify from the names. Iceland. I can never pronounce these Icelandic names. Now, the funny thing is, it was 17th April 2010, and I used to live in Europe at that point of time. In fact, I had already moved to Singapore the previous year, and I had gone back, wrapping up my stuff there. We used to live in a tiny country called Gibraltar, south of Spain. I lived there for many years. And I was driving to Heathrow Airport, and suddenly there was a news flash that this bad boy, starting with E, which is highlighted, I have no idea how to pronounce it, that has erupted. And that was projected to be a major eruption. The entire European airspace came to a halt. And, obviously the flights were canceled. And I was supposed to fly British Airways to Singapore. I was not too happy about it. I absolutely, don't like British Airways, but nevertheless, all flights were canceled. So I had this brilliant idea all the experts, volcano experts, they were projecting that this situation is going to last for months. You can see how dense the ash cloud was. So I had this brilliant idea of buying put options on British Airways. It's kind of like a revenge. Okay, they did not fly me back to meet my family. I decided to buy put options, and this was especially a very unfortunate time, because my anniversary was coming up, and obviously we had plans, and that was the reason I wanted to rush back. So I was really sad. But boy, I made a killing from those put options. I was kidding, guys. It was one of the most stupid things that I did. Now, in reality, the share price of British Airways did go down, but I lost my shirt in those put options. And you know the reason? So this is how the implied volatility would have looked like, the moment the eruption happened. I just, picked up, this is an indicative picture. This is not the implied volatility of British Airways at that point of time, but this is how it would have looked like. So I obviously ended up, and I did this from my cab. I was so stupid. I just called my private banker and asked the private banker in Singapore and asked him to place an order, and that was really, really stupid. I should have checked the IV and not done it. But anyway, I love sharing the stories of the stupid stuff that I have done, and trust me, this was not the first and the last time I did stupid stuff. Who wants to know an easier way to build wealth? You see all those snapshots of the share price that we used. Yeah, Anshul, everyone wants to get rich quick, and that is where the problem happens. That it just further delays their getting rich. So we kind of follow the slow path. Now, all these share prices, they're different market conditions. Now, the right thing to do would be to just zoom out, step back, and focus on the big picture. Now, they all belonged to this company, Monster Beverage. And as you can see, in the last 20 years, this has been one of the best performing stocks in the US markets. Starting from 7 cents, it has been a 732 bagger. Now, of course, the short-term traders would be speculating at different points of time on which way the stock price would be headed to. But if you are, instead of focusing on the stock price, if someone focused on the business, they would have realized that it's a phenomenal business. It has been steadily increasing their gross margins, their operating margins, their net margins. The return on capital has been, phenomenal. So it's not surprising that it has generated, a lot of wealth Now, it's a phenomenal business. Now, instead of looking at these periods as opportunities to make money from options, what if we change our perspective and think of these periods as opportunities to use option strategies to fund our stock purchases? And that is what we try to do in MoneyWiseSmart. Now, this is where expertise in using options from the perspective of a long-term business owner comes handy. And we are all long-term business owners. We don't do short-term trading. So the way we use options is completely integrated with long-term investing. Now, using options, we can help to generate cash flows to buy the business at these discounted prices. I have just drawn an indicative, this dotted line is the indicative intrinsic value. So when we analyze a business, we try to get a rough indication of the range of intrinsic value of the business. It does not have to be accurate. So, we will end up doing very well in the long run if, let's say, the intrinsic value is compounding at a rate of 15%. But if we can, buy the stock at lower than the intrinsic value, and there are option strategies which can help us to generate the cash flows, which we will see later today. There are times when the stock price is higher than the intrinsic value, when we might be sitting on cash. So there we can follow a different type of strategy, like, selling short puts with the strike of the put being at or below the intrinsic value. And unlike a trader, what a short-term trader would do is, sell the put and then hope and pray that the share price does not come down so that the put expires worthless. Whereas in our case, we know that our real return would come from owning the stock. So we would hope and pray that the share price comes down below the strike price of the put. If it does, then we get assigned the stock. So we become the stock owner and continue our journey to earn the superior returns. If it does not, then we get to keep the premium, and that gives us a return on the cash that we are sitting on. And sometimes what happens is, the puts do expire worthless. So, that takes away the chance of owning the stock. So just to ensure that we don't lose out on the upside, we take part of the put premium and buy a long call to capture some of the upside. Now, of course, this is a very, the crude structure of our strategy. There are lots of nuances, as our subscribers here would tell you. Every single month in the tutorial, we slice and dice this strategy. We look at different components, we take case studies, and we go into great depth, basically looking under the bonnet. Now, to exactly appreciate this strategy, we need to first understand how an insurance business makes money, and then we will be able to draw the parallel. And again, our subscribers, you would have heard me explain this a zillion times. So please bear with me once more, because as that this is the core concept that we use for options. So I can't help but repeat it. So just let your learnings be reinforced too, and then we will introduce new concepts. Okay. Now, for those who are not familiar, I have just tried to simplify an insurance business. Typically, an insurance company, they have two functions. One is the underwriting function, which basically underwrites the policies. And the other is the investing function. Now, the insurance company will sell large number of policies and bring in the premium, which is basically the cash inflow. And then they will have their running expenses, which they will pay, and they will pay out the claims as and when the claims come in. However, there is usually a long time lag between the time when a premium comes in and when a claim is paid out. And depending upon the type of policy, for some types of insurance, this time lag can be several decades. Think of a term insurance, a life insurance policy. The time lag could be several years. What do you think the insurance company would be doing with this cash for all that time? So what they do is they hand over the cash to the investing arm of the business, and basically the investing arm of the business, they get to invest this cash. Now, most insurance companies, they typically invest in bonds, or fixed income instruments, because they are worried that by the time the claims come in, they want the capital to be available to pay out the claims, and they are happy to just make the coupons. Now, Warren Buffett in 1951 had this historic meeting. At that time, he was just a 21-year-old student of Columbia Business School, and he had this meeting with a gentleman by the name of Lorimer Davidson, who at that point of time was the CFO of this company called Geico. Now, Lorimer Davidson explained this whole concept of how an insurance business works to Warren Buffett. And that was the biggest aha moment that Buffett had. And he realized that here is an amazing opportunity of using other people's money to grow his investment empire. And that is exactly what he did over the next 70 long years. So basically, the insurance company takes advantage of the time lag by investing float. This is called float. So when the money is just, when, they are just a custodian of the money, but they don't exactly own that money, it is called a float. Okay, now this is a screenshot from the Berkshire Hathaway shareholder letter, Buffett shareholder letter. And here, he explains it beautifully. He says, this collect now, pay later model leaves PNC, which is property and casualty companies, property and casualty insurance companies, holding large sums. Money we call float that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Though individual policies and claims come and go, the amount of float an insurer holds usually remains fairly stable in relation to the premium volume. So you can see that in 1970, Berkshire Hathaway had a total float of $39 million. Over the next, this is how many, 50 years, half a century, that grew to $129 billion with a capital B. So you can imagine the kind of compounding that happened. And look, there is one thing that I think a lot of people, they do not realize is, while Buffett has been a very successful, stock investor, but his brilliance lies here on what this one paragraph says. Now, it's not as if he had some special insights of finding businesses which no one else had. That's not the case. But this brilliance of using a very low cost, or in many cases no cost. In fact, think about it. In many insurance businesses, the underwriting side of the business actually end up losing money. But still, overall, the insurance business makes money because the investment arm more than offsets that loss. So you remember the formula which I showed? So the investment arm is responsible for the return on capital employed, and the underwriting part of the business is the source. So as long as that return is higher than the cost of capital, so the underwriting loss for an insurance business is the cost of capital. In case of Berkshire Hathaway, actually even the underwriting arm is profitable most of the years, which means that Buffett has a steady, continuous source of funding with a negative cost of capital. So that is the brilliance of Buffett, and that has created the magic over the years. Now, in our case, we learned this concept from them, and we implemented using options, where I personally feel that there is an advantage in case of an insurance business. When an insurance company pays out a claim, the money goes out of the system. But in our case, when we sell a put option and when the option gets assigned, the money stays in the system. So effectively, it is exactly like an insurance business. So this is how we replicate insurance business, using the same model. Now, that brings us to case number one, which is, I'm sitting on a lot of cash. How do I generate a return on it when the stocks are so overvalued? Remember that the Monster beverage portions of the share price when the price was much higher than the intrinsic value. So I'm talking of those periods. Here, I have intentionally used the example of this company called StoneCo. We have been researching this business for many months in the last year, and over the 5-6 months, by the time we finished the research, the share price had just shot up to over $90. Now, our calculated range of intrinsic value was somewhere between 40 and 55, $45 and $55. So we obviously did not want to chase the stock price because we will never overpay for something, but we had the cash. So what we did is we sold the put option at the 55 strike, which generated a nice cash flow for us. Now, by selling that put option, we took on an obligation of buying StoneCo for $55. Now, this is how the trade, this is actually a real position. So I sold 9 contracts at $55, and the option is supposed to expire in January 2023. And in the process, I have 675 days to enjoy the money. And the premium that I brought in was $11,250. Now, unlike a short-term trader, I am reserving the capital for a possible assignment, because if the share price comes down, which subsequently it has, now I don't know what will happen by Jan 2023. Still, it's more than a year left. But if the share price comes down below 55, I will be assigned. So I will need to keep aside this $49,500, right? And the total cash inflow from option premium, 9 multiplied by 100 multiplied by 12.5 is 11,250, which I got to invest for 675 days. So that is my return that I generated on this $49,500 of capital. And that works out to an internal rate of return, that is IRR, of 15%. Now here I have to mention that I have seen many short-term option traders, they just take a monthly return and multiply by 12 to come up with the annual return. But that is a very crude way. That does not take into consideration the concept of time value of money. A dollar received today on $100 of capital, it's a 1% return. And a dollar received a year from now on $100 capital is still a 1% return, but there is a big difference between a dollar received today and a dollar received a year from now. The dollar received today is float, which I get to invest for a year. And that is something which, all this ROC and all those formulas, they miss out. So that's why it's much better to use the internal rate of return, or XIRR. So this translates into a return of 15%. Now, if, however, StoneCo share price stays below 55 by the expiry of the option, then, just like what happens in insurance, a claim event happens and we are obligated to buy the stock for $55. But is that not what we anyway wish to do in the first place? So it's actually a good outcome for us. Now, of course, some of you might be thinking, but StoneCo share price has absolutely crashed now, $16, $17. So how is it a good outcome? So stay with me. It will be clear when we talk about the second case study. Now, if, however, StoneCo share price stays below 55, we have seen that this is what we wanted to do anyway. And moreover, we get to invest the 11,250 cash inflow, which we received by selling the put for 675 days. So that is how we invest float. Now, you would like to see our actual cash flow record. Now, following this exact strategy, this is how our monthly cash flows look like. This strategy and strategies which are similar, which we'll cover in case number 2. So, we have been doing this for a long time. And when I say we, I'm talking of the parent company of MoneyWiseSmart, but I have been keeping proper records since April 2017. So you can see our cash inflow has been steadily going up. Now, when I say steady, of course, it's lumpy. Like there are some months it's 10,000, 20,000, 30,000. There's some months it has been more than 100,000, 130,000, 60,000. And you have to understand that this is cash flow. This is not PNL. The PNL is different, and the red bars are basically months where we where we have purchased, spent more in purchasing options than in in selling options. Now, apart from that, we also have open option positions where we have locked in intrinsic value. And I will explain what that means. And it is completely up to us when we decide that we want to release some of that intrinsic value and convert it into cash. So, for example, in the month of November, I have generated, in the month of, this is December. This is not updated. I have generated around $25,000 of cash. However, I realize that now there are some, very attractive opportunities in the market. So I will take some of these option positions which have this locked in intrinsic value, and I will release more cash to be able to go and buy from the markets. Now, for us, this is the cumulative float that we have generated over the last, 4.5 years, which is close to $700,000. But the green dotted line is a representation of the value of the float, because the float kept on getting invested, and the market value today is significantly higher than that float that we brought in. So this is how we try to replicate the exact same strategy that we learned from Mr. Buffett. Of course, a few zeros must be are missing, but we are just following the footsteps of the master. So let me ask you guys to take a guess. Now, if we continue to do the same thing for the next 20 years, what do you think the value of our float will be, let's say in 2041? I will save your responses. So whoever comes up with the closest response, I'll send you a check. I'll send you a nice check. So let's hear some. Let's see some guesses in the chat. How much do you think the value of our float will be? By the way, I was kidding about the check. You would not need any check from me. If you understand this concept well, you will be able to cut your own check. This is actually what happened to the StoneCo share price. So while our put still has over a year for expiry, but the stock price has come down to $16. Guys, when you focus on the short-term stock price, and when your definition of investment success is the short-term up move of the stock price, like what happened when we were researching the business, there's some people who would have bought it and they would have, sent the stock price very high up and they started celebrating. So when your idea of your investment success is that short-term up move, then as a flip side of the same coin, you will feel disappointed by the short-term downturn in the stock price. Now ask yourselves, you don't need to tell us, have you experienced similar emotions recently? Now that temperament needs to change to become a successful long-term investor. Now, as some of you rightly said, when you have a steady stream of cash inflow, or you have strategies to generate a regular cash inflow, a situation like this is a cause of celebration. First of all, we have spent enough time to research the business. We think we reasonably understand the business. Now, of course, can we be wrong? Of course, we can be wrong. Like it has happened from time to time. But at a portfolio level, on one hand, when we have invested the time and energy in developing a deep understanding of a business, and when that knowledge gets combined with a steady stream of cash flows, I mean, times like these are actually cause of celebration. And I have been taking full advantage of times like these. And also, some of our other previous experiences, provide us the perspective. I mean, this is something that happened in 2018. I have been researching this company. The company is called iFast. It's a Singapore listed company. Many of you know it. Again, a great business. I've been researching this company. I really liked it. I pulled the trigger at around $1.10, and then boom, the share price crashed to somewhere 60 cents or maybe even lower for some time. Now, rather than getting worried, I used my float that was available to me at that time. I kept buying heavily, and my weighted average purchase price came down, and then boom, this happened. Same is the case with JD. For those of you who missed, yeah, it has been a phenomenal outcome in case of iFast, and they keep executing, amazing execution. And the same happened in case of another of my position, JD.com. Bought it around 30, the share price came down to below 19, and then kept buying heavily. And of course, off late it has been up and down, but still, considering where I purchased, it has been a significant. It has been a multi-bagger for me, and this company has been strengthening their moat over time. So these are some of the opportunities that those option cash flows allow us to fund. So this session is not about these businesses. This session is about those cash flow generating strategies. Okay? So real wealth is not created by speculating on the direction of short-term share price fluctuations. Real wealth is, sorry, lost my page. It is created by owning high quality businesses over a long period of time. For us, short-term share price fluctuations create opportunities to fund our long-term purchases, using innovative option strategies. Now, if you like to see what we do with the float which we bring in or which we have brought in, type float. So if you are interested in seeing, I will actually share with you what we have been doing with that float. All right. So this is a picture which I shared during the last webinar which we conducted in October, that is 20th October, which many of you have attended. So at that point of time, our float got invested in multiple different ways, some option strategies, some long stock, and on that particular day, we were sitting on an unrealized gains of $2.6 million portfolio, which was significantly larger. And this is purely from the float. This only includes the US optionable positions where we listed the float. And this is a screenshot from our software, which we use to keep track of all our positions. Now, fast forward to last week, we have, of course, given back quite a bit of that profit, but I always, share our actual figures for the sake of transparency. Otherwise, why would you guys want to listen to me? Unless you really see what we have been doing. Now, as you can see, we have given back quite a bit of the gains, but again, thanks to the steady incoming cash flows, this is actually a good situation for us. And, we are not at all worried about these market price fluctuations because we know that it is times like these where we get to really coil the spring, and when the market goes back up, I'm pretty sure it'll take us significantly higher than where we were earlier. Now, this would have been a scary situation without any cash flow to take advantage of the correction, and if I'm forced to sell my shares for whatever reason. But what if we manage to generate an ongoing fresh cash flow to be able to take full advantage of the amazing deals that Mr. Market is offering us? And that brings us to the case study number 2, where, I had used up my cash buying all these deeply discounted opportunities, let's say very little of my float is remaining in cash. So how do I generate a cash flow to fund these abundant undervalued opportunities? Like I would ideally like to buy a lot more of these companies which are now available at a deep discount. So in this particular strategy here, I have taken just the example of meta platforms, which is Facebook. And let's say I don't have too much cash left, so I go ahead and buy a long-term call option. This is the payoff diagram of a call option. So essentially what I'm doing is I'm buying the time value. And against that, because in the long-term call option, my upside is open, my downside is protected. Against that, I keep selling some shorter-term time value. And by the way, guys, just stay with me. This is what I'm explaining now is the first step of this strategy. This is just to explain the structure. So this is essentially a calendar spread where I buy a distant option, and against that I sell a shorter term option. So I sell the shorter term time value. But the good thing is, after some time, when the shorter term option expires or just before expiry, maybe if it's in the money, we need to roll, we can keep rolling it and we can keep bringing in cash flows. So this for us creates a nice source of an ongoing cash flow. And here our objective is to ensure that over time, I create a slight difference in the strikes between the long-term option and the shorter-term option. So this difference is the locked-in intrinsic value. Now, it is not guaranteed because you will understand that if my short call strike falls below the long call strike, then I'm opening up a risk. So that is negative intrinsic value. But if my short call option is higher than the long call option, effectively, the long call option allows me to buy at this price. And then, if the short call obligates me to sell at a higher price, so this is a locked in intrinsic value. Now, why I call it locked in intrinsic value? Because at any point of time, I can decide to, release some of the cash by rolling down the call. And that rolling down the call strike, when I say rolling down, as in the strike, that I can do within the same expiry itself. So that is completely in my hands. Now, for the beginners, if you are finding it difficult to follow, don't worry. I mean, focus on the fact that these possibilities exist where I can buy a long-term asset, put some money in that long-term asset, and against that, I can keep selling a short-term or keep generating a short-term cash flow, and also have a mechanism where that long-term asset can also go up in value over time. So this is somewhat, not exactly, but somewhat it can be comparable to, let's say you have bought a property and you earn a rent month after month. But there are many more nuances in it. Now, so this is the structure. So let's look at an actual option chain, and I will share with you a back test, which I'll take you through it. So here I'm just taking the SPY ETF, and this backtesting in this software, I can go back in time. So I have taken the early 2019, the first day of 2019, where I go and buy the farthest available call option, which is December 2021. So which is almost 3 years down the road, 1,080 days. And against that, I have the option. I have the choice of selling a 9-day option or 16-day option. So here you can see there are weekly options. So now imagine against this long-term option, I can end up selling 52 multiplied by 3 over 156 weeks, which means 156 times I can roll the short option. I mean, in reality, it's not always possible because it depends upon the market moves, but that is how the structure is. So I end up buying this long-term call option of 250 strike for $34.50. And against that, I sell an option which is just expiring 9 days for $3.60. So I'm actually bringing in more than 10% of this, and I have 3 years of roll to happen. So this is what this looks like right now. I would say don't worry about this payoff diagram. Let's just focus on the option legs. So this is the calendar spread that I have, and let's go forward in time to just a day before the expiry of this particular option. So just when 1 day is remaining, you can see the share price has gone up, and this short call, if I don't roll it, it will get assigned and I will end up with a short stock position. So I have to roll it out, but it has gone up in value. So I have to buy it back at a price which is much higher than what I sold it for. But I can roll it by 15 days. And by doing that, I can roll it to the same strike and I can bring in a higher premium. So effectively, I bring in a credit of $106 because I bring in $9.81. I had to shell out $8.75 multiplied by 100, so $106. And this is just for one contract. I mean, in reality, depending upon one's account size, one can do 10, 20, 50, 100. These are extremely liquid options. So as you can see that I started with entry debit. This is what was the outflow, right? When I started of 2946. So now the entry debit has reduced, which means I have brought in a cash flow. So like this, I can keep rolling this. Next time again I do it, I bring in another $135 of cash flow. And every time I'm bringing in this cash flow, the idea is to find the most discounted opportunity available in the market and go and buy that. Because remember that we think differently than what a trader would think. For us, this option strategy is just a funding source. So while we are bringing in cash flow, while it'll be a great outcome if this strategy itself becomes profitable, but for us, the main bang for the buck comes in owning the stock, which we are accumulating over the months and years. Now, let's fast forward to the time when the markets were hit by COVID. So April was when the markets were just recovering from the March lows. And you can see by then the 2,900 debit has now already become 2,100, which means that already about $800 of cash inflow has happened. And here you can see that I started with 250 strike for both. And now this short call has moved up to 251 strike, which means I have already locked in $1 of intrinsic value along with bringing in all these cash flows, $900 of cash flows. Now here, I now have two options. Now, what happened is in March, thanks to the COVID, the implied volatilities shot up. And when that happens, it gives me more ammunition to roll, more choices. So I had an option of either rolling out and rolling up and packing in $4 more of intrinsic value to pack in total. So this is like, I look at it like a battery where whatever energy you're not using, you're storing it here, which you can use anytime in future. And if I do that, I will not, on this particular roll, I will not release too much of cash, but then I also have the option of actually going back to my original strike of 250 and releasing some over $400 of cash right in this one roll. So you see how powerful that is. Now, in this particular case, I think this makes sense to do it because in April, there were a lot of, again, I'm talking April 2020, just when the markets are recovering from COVID, there were a lot of undervalued opportunities available at that time. So I would like to release the cash to take advantage of that. This is just my funding battery, right? So now, if I went for the 255, this is what the payoff diagram would look like. So as you can see over time, the profit zone has expanded quite significantly compared to where we started. Now, by the expiry of the long call, not only would we bring in large number of cash inflows through the short calls, which is likely to more than pay for the initial time value of the long call, you also have a high chance of the long call to be in the money, like what you saw in the money, as in where we are packing in some intrinsic value and significant amount of intrinsic value to be locked in. Because don't forget that we are talking of a 3-year period. We are still only in April, and we still have another 1 year, 8 months to go. So this would significantly boost the returns from the option position itself, apart from generating the ongoing cash flow for the stock purchases. Now, some of you might be thinking that, hey, isn't this something very similar to the poor man's covered call? The answer is no. Here, I'm just trying to explain the structure of how this strategy works, but we would not be implementing it the way I showed. I mean, this is just the introduction of a calendar spread. Now, as I said, the main return would come from the purchase of the stock. Now, in this case, just to keep things simple, I have just taken the example of SPY. Now, imagine in April, I would have bought SPY for 252, and by now it would have almost doubled. So, even if the option strategy by itself, let's say the tiny probability where it does not end up as a profitable strategy, the way I look at it is that is just my cost of funding, just my cost of capital. So as long as my return on capital employed, and where is that capital being employed? The capital is being employed in buying the undervalued stock. So as long as my return on capital employed is higher than the cost of capital, I'm fine, I'm good. So it boils down to that particular formula. Now, however, here are the caveats. So this is just to ensure that don't, the moment this session is over, or maybe some of you are, doing it now, don't rush to your brokerage account to do this because there are lots of caveats. Now, here are they. What if the short call gets assigned before you get a chance to roll it? That will be messy. You will end up, with a short stock position. What if the IV of the long call is so high at the time of purchase that the series of short call premiums are not enough to cover the premium paid for the long call? Or what if the near-term IV is implied volatility? What if the IV collapses such that we hardly receive much premium for the very short-term calls, forcing us to go further out and reducing the number of rolls? And sometimes that happens. Sometimes when the IV collapses, what we initially thought we will be able to roll every week, it can end up being able to roll just once a quarter for a credit. What if the stock price moves down significantly such that we are forced to roll down the strike of the short call below the long call strike? That would open up the intrinsic value risk. If the short call strike falls below the long call strike, then we are opening up the risk, which is again not something that we would want to do. And these are all the risks of that poor man's covered call. I mean, as far as I'm concerned, it's not a very smart strategy, which a lot of people seem to like. And finally, what if the stock price moves up so much that while the long call, will be sitting on unrealized gains, but there is hardly any time value left in the original short call strike, because now this original short call strike is deep in the money. So in a situation like this, it would be a bit difficult to roll. So what do we do about these caveats? So the good news is we have solutions for each and every of these caveats. And this is something which I will be introducing as our subscribers, that we don't like to rush into anything. So we would be gradually over the next few months introducing you to the solutions for these caveats and putting the different parts of the table very logically to address each of these concerns. Now, the first session which we will do, and this strategy, these specific details will only be available to our diamond level subscribers, because this is fairly advanced, some of the concepts that we will use to address these. Now, I went ahead and did another backtesting using exactly the strategy that we are going to use in 2012. And there we used the same mechanisms to solve all these problems, to make that strategy completely risk-free. And the results have been very encouraging, and that too using just SPY shares, to purchase. Whereas in reality, the return that we would get will be even higher for several reasons. One is we will invest the cash flows into the best possible opportunities, which give us the maximum expected returns. I'm sure, like right now, there are opportunities which give us much higher expected returns than what the overall market would give. And there are a few other factors. There are a few new developments that have happened from CBOA's side, which make this strategy even more powerful. And this is, in case study one, the strategy that we introduced, that's a very powerful strategy, but I don't think that even comes close to how versatile this particular strategy is. For those of you who have met Vaibhav, so sometime back, I introduced this strategy to Vaibhav. I had a call with him and I asked him to punch holes in that strategy. And both of us, we have done extensive backtesting. He actually went back to 1999 and did backtesting for rolling 5-year periods. And his results have been amazing. So he actually went ahead and entered a position even before I did. I just entered this position. I have been doing other forms of this strategy, but exactly in the form that I'm going to introduce our diamond level subscribers, I just entered the strategy just yesterday. Would you guys like to see what I have done? So here is a screenshot from my actual interactive brokers transaction. Now I have grayed out the actual option positions because I don't want to confuse anyone. I know there are people at different levels, and there are many nuances that we need to first introduce before someone can directly go and jump in. But I will be removing this gray box, and I will actually be scheduling the upcoming diamond level special tutorial sessions on exact days when I will be rolling my options myself. So I will actually do it in in some of the roles. I'll do it in front of you. Now here you can see that I spent $164,000 buying the long-term option or options or whatever I did. Okay, so that is the long-term time value. So this is mostly time value which I bought, and against that I brought in a cash flow by selling my short-term position, which is again mostly time value. And the nature of this, the way I have done it, my estimate is that it will allow me about 40 to 60 rolls in future. So just imagine, all I need is 8 equivalent rolls of the same cash flow to pay for this. Now, of course, all the 40 to 60 rolls, I will not be able to bring in the same amount of cash. Some of them will probably be a lot lower, but still my back of the envelope calculation tells me that it will be a very, significantly profitable strategy. Just I have to be patient and be disciplined. I have to keep a few things in mind and not break some rules. And you can see that the moment this cash flow came in, what did I do with this cash? $22,000. Immediately, I went and purchased 1373. I mean, this is not the only position in stone. I have, right now built in a large position I purchased it at $16.11. And that helped in bringing down my weighted average purchase price of the stock. And I'll keep accumulating. So you can see that that is what I have done. So this is the actual transaction which has happened. And it's, I'm actually very excited about this. And I'll keep showing you. So this particular position of mine will be an open book. I will add to this, and I will be our diamond level subscribers will be absolutely privy to exactly the day when I'm doing the transaction, so that whoever is interested. It will not be a recommendation. There are different ways of implementing this. There are different ways of skinning the cat, but nevertheless, it can provide you with some guidance. Okay, now the cash flow not only funds the undervalued stocks, it also pays for my lifestyle. I'm a very avid traveler. I absolutely love backpacking, and my way of traveling is not going and doing luxury holidays, but traveling to some of the most remote parts of the world. This picture on the bottom left, this is the world's least visited country, or one of the least visited countries, Tuvalu, where I was backpacking with my son. Here you can see my son. He managed to he's carrying his lunch. That is what we had for lunch. And these guys are actually Tuvalu's national rugby team. So they have just 3 flights coming in, and they use the runway to practice their rugby. This is, I'm sitting with some fishermen in a fishing village in a remote island called Gunu in Fiji, where we were there. Nepal, we were in Samoa. This is called a Fale. This is just by the beach. You can see the Pacific Ocean, and this is where my son and I spent our night. You can see our 5-star accommodation, where there were just 2 thin mattresses on the floor, which I think we got a VIP treatment because somehow the owner liked us. Otherwise, it would be just maybe sleeping on the floor. This is, in a tent in Fiji. So this is what I like to do. And, some more. This is in Vanuatu. We were in the same flight with the Vanuatu Prime Minister in a remote village in Nepal called Gandruk village, some South American cities. This is my younger son trying to meditate, sitting on the Salar de Uyuni, Bolivia. So why am I showing you this? I'm showing you these pictures because each and every of these trips have been paid for by the option cash flows that I brought in over and above paying for those stocks. So now you will get a perspective that when there is a significant correction in the market, as some of you rightly said, I mean, I do celebrate. And my travels around the world actually help to broaden my mind and makes me a better investor. And, I'm very happy that my business partner, Fan Liang, he also loves traveling. I mean, he is a digital nomad. Fortunately, he has the advantage. He still is not married, doesn't have a family. My kids, schools and all put some restriction on my traveling, but, he's a free bird, decided to move to Georgia, Tbilisi, and stay there for 6 months. And after that, wherever his travels take him. All right. So all that finally boils down to, I mean, you might ask, okay, all that is good, but what has been your investment track record? So let's see how all this has worked out for us. And here I'm not talking of only options. Here I'm talking of our entire Interactive Brokers portfolio. So this is how all this has boiled down to. This is my early years of investing. And this was a result of, and I'm talking of my absolute early years of investing, a lot of ego, not understanding the difference between price and value and being focused only on stock prices, speculating with options without having a system. So I was making exactly the mistakes which I showed you right at the beginning that most short-term focused option traders make. I was over trading. I was not appreciating the concept of compounding and time value of money. And I only had superficial knowledge on the companies that I was investing in because I did not invest the time to research and build conviction because I didn't have that time. I was so busy. I had a full-time job at that time. That was over a decade and a half back when I was in full-time employment. And I was paying a lot of attention to noise. I used to think that watching CNBC is a very smart thing to do. And watching that, that monkey Jim Cramer, rattle out stuff about companies, I used to think that, that is the right way to invest. Can you imagine watching him and going and, buying those stocks? So I was, in short, being delusional. However, fast forward to the last, 5 years, you can see, and this is my actual track record. The blue lines are mine as in the parent company of MoneyWiseSmart, the Indigo Atlantic family office, we have decimated the S&P 500 or any other indices. And I consider any track record. I mean, I know a lot of people, they boast about, oh, this is what I've achieved in 3 months time, 2 months time. It really doesn't matter, because that is mostly just short-term fluctuations in stock price. I mean, 5 years is the least period if you want to attach some seriousness to a track record. S&P return 14.4%, whereas our return has been 22%. And this has actually been better than what I shared in the last webinar, because last quarter has been fantastic. However, this month, as you can see, I'm slightly trailing the market, but that's okay. That's the short term. Think of look at what happened in the last 1 year, and this outperformance has happened solely because at the peak of COVID, during that COVID correction in March, I received some very nice cash inflows, which allowed me to take full advantage of some really undervalued opportunities. Alrighty, so this happened because I was committed to learn to invest the right way and follow the right framework, which involved the ability to research high quality businesses, ability to generate cash flows, to take advantage of the opportunities, develop the right temperament, understanding of all the other not so sexy secrets of compounding. Now, we had actually some time back conducted a session where we talked of many of these other aspects of investing, like transaction charges, bid-ask spreads of an options, and all small leakages which act like termites to our portfolio. Taxes, insurance. This is available on YouTube. You can you can go and check out this video on YouTube. I'm very confident that it will really be an eye opener for many of you. Because we normally don't think of those things. So maybe Fanya, if you can find the link of the YouTube video, you can share it with them. Okay, so how many of you realize that there is a lot more to learn to be able to implement this knowledge properly? Now, how many of you realize that without a process for generating an ongoing cash flow to take advantage of the market corrections, you would find it very challenging to deal with the emotional roller coasters and hold on to the great companies which you might end up buying in the first place? So our belief is your cash flow can help shape your temperament. So, that is what we think helps us to keep our eyes away from the stock price and basically treat the stock price as an opportunity that Mr. Market is throwing at us, from time to time. So as long as we have, the right knowledge, as long as we have the right temperament and the cash flow, that has been the winning combination for us. Now, that is the reason we have created our option series program. Now, it is not for short-term trading, but it is a framework for cash flow generation when you need it the most. So there seems to be enough interest to learn about our option series program. So I will share with you what we do in our option series program. All right, now expertise in any domain is not achieved overnight. Just like expertise in sports or music, or if you're a surgeon, it takes a lot of hard work, commitment, and a lot of practice. Now, in our option series program, that is the whole reason why we created the option series program, is to be able to generate cash flows when we need it the most. Now, as I said earlier, this is not for short-term trading, but it is a framework for cash flow generation when we need it the most. The main purpose of the option series program is not to speculate on the short-term movements in the market, but to take advantage of the increased volatility, like times like these, and this is when we take advantage of our option series program, our option strategy. Now, in our option series program, you will learn how to use the option float to fund your investment portfolio, strategies to generate cash flows to boost your returns, position yourself to acquire more shares of your chosen businesses at your desired price, generate an attractive yield on the cash that is waiting to be deployed and not earning anything in your bank account, and
for some strategies generate explosive profits by risking very little capital. For example, I shared with our subscribers, sometime back, there was a Berkshire Hathaway trade where I invested $10,000 and came out with $125,000. So those don't happen often, but from time to time, we get those kind of opportunities. Now, I have invested huge amount of time, energy, and my money in learning from the best of the best. Now, I'm sure I don't have to tell you who this person on the right is. I have been a very ardent follower of Taleb's philosophy, read his books, and I also did not miss any opportunity to meet him. So this picture, I've taken this picture in NUS where we were having a session with him, and these two gentlemen in the other picture are my first mentors. And some of you might know them. The name of the guy in the black t-shirt is George Fontanelles, and the other one is Tom Gentile. So they are the founders of this company called Optionetics. Many of you use options analysis software. So that's actually an offshoot of that company. And Optionetics subsequently got acquired by Options Express, which then got acquired by Charles Schwab. Now, I think I would have invested at least 50,000 US dollars, learning from them. I would fly to the US every quarter. I was in their core mentorship group. There were a very few handful of people who were selected, and, learned a lot from them. And also side by side, worked on Taleb's teaching, Taleb's philosophy. Now, the interesting thing is, the important uniqueness about our program is that this is not a trading course. Now, as I said, we are not short-term traders, and this program is completely aligned with long-term investing, which actually none of these people, they do. So what happened in my case is I started trading using whatever I learned from these gentlemen. But then once I got introduced to Warren Buffett's teaching, I was able to, I was completely blown away. That sounded very logical to me. I read everything that I can lay my hands upon. And that is when I decided to marry the two, the teachings from these people, along with the way how Warren Buffett uses options, how Warren Buffett runs his insurance business. And it didn't stop there. I continue to further my education. I did extensive amount of courses on Coursera from different universities. This is, a very intensive 6-month program, which I did from the University of Michigan Ross School of Business. I attended the executive education program offered by Columbia Business School, trekked down to New York. You can see this, this invoice here. Now, I sometimes think for less than a week, of education, they charged me 7,200 US dollars plus, whatever investment in, my air ticket, stay, more than $10,000. Now, when I think of our option series program, I feel very confident that what we offer is actually significantly better than what any of these are all high quality programs, but what we offer is much more elaborate because our subscribers have lifetime access, which means even 10 years from today, it will be with the same intensity. We will introduce new strategies, handhold them, conduct monthly tutorials, etc. Whereas none of these programs, they have any, after support. Along with that, I also have been an extensive reader. I have been trying to emulate my master, Warren Buffett. He reads 6 hours a day, 500 pages a day. I don't, possibly read 500 pages, but nowadays I realize I actually end up reading, maybe a couple of hundred, and hundreds and hundreds of investment books. And along with that, I invested a lot of my time, energy, and money in backtesting everything that we do. So the strategy that we introduced today, both Vaibhav and I, we have been backtesting it. And in the past, I have even hired interns from the local universities like NUS, SMU, NTU to come and work in our family office to backtest many of the strategies. So that is how seriously we take our, what we do. And finally, this is the crown jewel, Buffett's shareholder letters. I have read each of them multiple times, and I don't think anything comes close in terms of opening my eyes to the right way of thinking about long-term investing. And finally, I always believe that the best way to learn is to teach. So over the last several years, I have been actively involved in teaching both online and offline. These pictures are, some of the local universities like NTU, SMU. I've been invited as guest lecturer multiple times to actually share with the students, both masters as well as the, masters in finance, as well as MBA students about what we do. This picture on the bottom left is our industry group. This is a very active group that we have in Singapore. Great group. We benefit a lot where we share a lot. So this was one of the sharing sessions. So what we have packed in our option series program is basically everything that we have acquired from all these sources. It's to make lives easy for our subscribers, so that our subscribers don't have to go through all the pains of traveling around the world, going and doing multiple courses, blah blah. This is hosted on the Teachable platform, has over 150 short videos, completely self-paced, and it comes with excellent, literally personalized support through our tutorials and through our Facebook group. So this is the actual program, as you can see, scrolling up. So all these various modules which are there. This handsome guy, Vejo, he's one of our subscribers, and he talks about how he has benefited from the program. Now, he has been very committed, and I have highlighted this paragraph where he says, I managed to recover the initial course fees within a short period of time, and I'm confident that the skills I have learned will benefit me for the rest of my life. I highly encourage everyone who has investable cash to join the course and take active steps towards wealth generation. Our option series program has 2 levels. Now, the silver level is suitable for beginners, who are absolute beginners, who are looking to only learn some basic strategies along with the risk management techniques. It's still very elaborate, actually much more elaborate than what most other programs offer. But for us, this is a self-contained program. So if beginners, you want to first become comfortable before you move into more advanced strategies, this is perfect. The diamond level is basically everything that is there under the sky when it comes to options, suitable for investors who are committed to achieving expertise in using options to significantly enhance their long-term investment returns. And as I said, this expertise will come over time, but I feel very happy to see the progress that many of our subscribers, in fact, many of them are present here, they have achieved. The silver level comes with lots of modules, but what would be relevant here is for you to understand the benefits. It very comfortably helps you to generate cash flows to fund your stock purchases, manage the downside risks, which is very important for us. We never take our eyes off the risk, and significantly increase your returns from your portfolio and cash flow rates. Plus, it comes with the additional benefits of quizzes, very high quality personalized support, which we are very proud of, live Zoom tutorials every month end, last Thursday of the month, guidance in position adjustments, preferential pricing for other programs, as well as lots of case studies. The diamond level contains everything that the silver level contains, and plus all the advanced modules. I mean, we don't leave anything out. The very, very powerful advanced modules, which some of them we use in the strategy that we discussed today. But the benefits are, in the diamond level, our subscribers learn about cash flow strategies which most other option participants are unaware of. They're able to buy stocks at bargain basement prices when most people are running scared. Be in a position to identify opportunities which most others will not know of, and be in complete control of your investing journey. And this is some of the analysis of our students' positions that we do in our monthly tutorial. As you can see, the names of the students. We won't go into the positions, but what we do is every month we invite case studies where our students, they submit their actual positions, and we slice and dice, analyze them, come up with different alternatives of doing things. And it has been very, very helpful to our subscribers. Now, I don't claim any credit for the right-hand side of the screen. I mean, these are all, their commitment. They have done this. And this is basically a snapshot of one point of time when we did the analysis. Subsequently, from many of these positions, they would have made a lot more money. This is completely their commitment of learning and then implementing and getting the results. So, and we define our success by the success of our students. So when we see amazing results, that is basically feathers in our cap. And our tutorials are not just run-of-the-mill tutorials. We regularly receive 5-star ratings from attendees, and you can see some of the comments. People absolutely love the session, find it very useful. And this is one more testimonial from another very committed subscriber, Chen Chang. Highlight the last line, that knowing the value of companies and then using it to price my option strategy. This very end result is getting more of a company at great prices and getting paid while waiting. So he is basically talking of the first strategy that he is familiar with and has been doing very well. Says the value I gain is multiple times the fees I paid, and the value keeps compounding. Wow. The very fact that you have stayed with us till the very end shows your commitment to taking your learning forward. Now, what we have done today is just scratch the surface. There is a lot more out there that we want you to have absolutely free access to. So what we have done is created a free preview for our option series program, where we have published many of our strategies, our case studies, and a lot of our tutorial videos for you to access absolutely free of cost. So you can join the free preview by clicking the link, which is there in the description section below. And I would love to see you there.